Improving Alpha, Innovation in Investing, ESG, and Technology with Michael Oliver Weinberg, in partnership with Vidrio Financial, is being sponsored by Alternatives Watch and thefundmarketer.com. For a 360-degree view of investor mandate activity across alternative investments, turn to Alternatives Watch. Thefundmarketer.com is a comprehensive directory of products, services, and information for asset management sales and marketing professionals. With Vidrio's data management solution, we shoulder the responsibility of your data, from its collection to extraction, transformation, and enrichment. Vidrio monitors over 2,000 diverse funds, processing millions of data points each month, while leading the discussion on how investors can harness advanced AI and human expertise to maximize alpha performance and enhance data accuracy. Discover how Vidrio empowers your data with comprehensive analytics on performance, cash flow, risk, and valuation, all delivered seamlessly through Vidrio's Data Management Hub. Save your investment team valuable operational time, providing actionable insights like never before. Explore more at vidrio.com.
Hi, this is Michael Oliver Weinberg. We'd like to welcome everyone to the Improving Alpha, Innovation in Investing, ESG, and Technology podcast series. Today, Mazen Jabban, founder and CEO of Vidrio, will join us. For context, Mazen has always been an innovator in both technology and investing, so it's no surprise that he continues to innovate in these areas. Why don't you start with your background, particularly pertaining to the intersection of investing and technology? On that note, welcome, Mazen.
Thank you, Michael. Thank you for having me. Just a little bit about my background. I have an undergraduate degree in engineering from University of California, Berkeley. Then I got an MBA in finance and investing from NYU Stern. And I founded a fund of fund business 30 years ago to invest and seed hedge fund managers. Inside that firm, we built a comprehensive investment platform to be able to manage the entire process of portfolio management, all the way from research to diligence, all the way to risk management and reporting. 13 years ago, we spun off the technology and the data team into what's today Vidrio Financial.
Let's get right into the topic du jour, or the most juicy thing that's certainly in the equity markets, and I would argue in the VC markets, AI. What's your high-level view on AI as it pertains to investing and how it will transform investing, having been an innovator in fintech for so long?
Well, I think that AI is going to transform every single industry. The investment industry, which is basically dealing with information, is probably much easier to transform than, say, an industry where you have also physical materials in it. I would classify it among a few things. One is efficiency and speed. AI is going to enable automation of data collection, processing, and analysis. So it's speed of collection of high volume of data. The second thing is in the decision making. So you have a vast set of data, user-friendly way to interact with the technology. You don't need to be a tech person in order to be able to take advantage of all the data that's there. You could probably, in a natural language, be able to ask the right questions and get the corresponding answers. So that, I think, is going to enable decision maker to basically be able to follow trends and cover investment opportunities. A third point I would make is on the risk management. Same thing, this user friendliness and the ability to uncover risk in asking simple, basic questions as opposed to being able to drill through rims of data in order to find out more. I think this is going to inform decision. Another point is personalization. I think that the AI is going to allow a high level of personalization of portfolio at a low cost. You could see a future where every investor have their own custom portfolio as opposed to be investing in a commingled portfolio purely because of cost considerations. So this is going to be a democratizing effect. Another one is the ability to access alternative data, unstructured data that can be very useful to basically add on to all the structured data that a typical investment firm is looking to. However, there will be challenges. I think the two main challenges, one is the ethical consideration, and the second one is the transparency in the AI decision making. Why did the AI come up with these decisions? If you are not able to find out what it did, and I think, Michael, you know that from your experience in Move 37, it's basically what did the AI do in order to come up with this answer?
Yeah, I couldn't agree more with the last point. I mean, I agree with almost, if not all, of what you said. But to your point on the last point, I mean, yeah, the SEC is already demanding, what you do to match what you're really doing. There was the SEC case just recently where it went after a couple of RIAs who were misstating what they were doing with AI and how they were doing it. And that will become increasingly prevalent where the SEC will demand accountability and understanding of what it's doing and why it's doing it. So I think that's spot on. So this is going to require material technological investment, I would think. And obviously this series is geared towards asset managers, asset owners, and other people generally in the investment business. What are your thoughts on technological adoption and what should maybe allocators and asset owners be doing?
I think the first thing that these institutions should be doing is they should realize that the technology decision right now should be a strategic management decision and not an IT budget spend. I think this is number one, because if you look at this as more a investment in technology, meaning IT, the way it has been in the past, you'll miss the boat. You'll miss the opportunity to really benefit from that as an organization, as management, as a business. I think the second point is you need to decide the level of complexity you're willing to embrace, because it's easy to talk about AI and technology, but it's much harder to implement. So you as an organization, you need to decide the level of complexity that you want to embrace at that point. And we can get into that more in detail. Is it something that you want to buy or you want to build? You should also move to have a cloud computing infrastructure, because trying to build everything in-house is going to be very challenging. You need to use robotic process automation. You really need to automate all the automatable processes possible. And then you need to take advantage of advanced data analytics to analyze vast amount of data. Okay. So basically, this all should be process driven. And in order to do that, you really need to foster a culture of innovation. Most people tend to be using tools in technology and be satisfied with the tool as long as the tool works and they get their job done by the end of the day, without really any consideration to the overall organization and the mission of the organization. So I think it would be very important and that should be a top management decision, in a focus on innovation. And obviously that goes hand in hand with continuing education and training. This is not just one and done. You have to continuously train because this is fast moving.
Yeah, I mean, you've made so many poignant points. One that really resonates with me is the buy versus build, because if I think back to my days at Man Group FRM, where we had Blaine and we had a slew of developers on staff because we were largely building, but it was so immensely, the resources we threw out were so immense in terms of people. And then Protege was similar. And of course, we ultimately ended up having that as a sort of business in and of itself, a fintech business. So to me, most companies don't have the resources, ability, knowledge to manage, build themselves. I would think for most asset owners and asset managers, the right solution is buy. I imagine you wouldn't disagree with that.
I do, unless you're willing to put the resources and the amount of money and understand that this is basically a different business than your own business. Building the technology, collecting data, organizing the information, it's very different from the investing business. It's another business.
100%. And what about asset managers? Do you view them as a sort of parallel, or do you think it's different for asset managers than asset owners?
I think it's fairly similar. The only difference I see is that you have another level of complexity, which is you have a client interaction. Okay, so you are an intermediary as an asset manager, and therefore you have investor, you have LPs, and you need also to be able to, within that framework, within the platform that you are thinking about, is to be able to provide transparency directly to these investors and the reporting. So that should be all integrated and not an afterthought. If you look at what most asset managers do, they have an investor relation department, and what they do, after the fact, they basically use a combination of Excel and PowerPoint, and then they kind of build reporting, bespoke reports for clients, which is too late and very much well curated, as opposed to providing more transparent data into what the client owns.
So it sounds like you're really espousing more real-time data.
Absolutely. I don't see a reason why an investor should not have access to the same information that the general partner or the asset manager has at the same time and at the same level of granularity if the investor wishes to.
Yeah. And again, and that can even be aligned with the new SEC private fund rules, as long as the manager offers it to all investors simultaneously in the same terms, that can work. Totally. All right, well, let's move on. What about data management? Again, so it's something you're intimately familiar with, the exponential growth of data. The price of processing and storage has declined similarly exponentially. For example, $1 million of computing in 1980 is about 2 cents today. What about data management for asset owners and or asset managers? Curious to hear your thoughts.
I mean, I can go back to my experience as a fund manager back in the 90s and 2000. When we were running the fund of fund business and we decided to build the technology in-house because we couldn't find that available, we realized very quickly that our technology without the accurate, timely, and complete data was not very useful. And we also realized that analysts and people who operate within the investment space are not the right people to be managing data. A, they don't like to do it. And B, they don't really have the skill. You know, being a good analyst, that doesn't give you the skills to be a good data manager. So we very early on ended up building a dedicated data team that's sole responsibility is to collect accurate and timely and complete information to be fed into the technology platform. And when we spun off Vidrio, we basically decided not to spin off just the technology, but to spin off the technology and the data team. I'm a big believer that technology without accurate, timely, and complete data is really not very useful. If you don't have that, Excel is probably a better tool. And the second thing is you need to implement a robust data infrastructure. In order to do that, you have to make some decisions. So you either need to build a robust data team with advanced technology to manage the collection of documents, data extraction, data enrichment, reconciliation, and filing. Or you're going to decide to basically, do you want to build this or you want to buy it? You want to buy the service. The investment team should be focused on using the information and not at gathering it. I think also very important to embrace transparency in reporting. We discussed that in the previous point. And you really need to put the data at the center of your strategic decision support.
You alluded to this earlier. You were saying there should be this paradigm shift, if I don't misunderstand what you're saying, a paradigm shift. In other words, asset owners and or managers should really be looking at AI, technology, data exploitation in a positive way. I think you're saying really like in a paradigm shift, like it should be looked at differently. It shouldn't just be like, we're upgrading Windows or your PC's reached its end of life. Is that fair? Or you're saying that people should embrace and or really make an exponential change? Exponential is not the right word either, but you get my point.
Yes, I think that organizations should recognize that technology decisions are strategic in nature and they rest with the top management. These are not tactical decisions about buying tool A or tool B or service A or service B. So you have to think about that. And it should be, the reason it should be at the level of management, because it covers multiple departments. Unfortunately, today, most organizations try to think of it in terms of the department. You need the operation team needs to do certain things, so that you look for a tool or a technology to cover that. The research team needs to do this. Everything today is thought about as a tool instead of thinking of it as a platform. So I think it's a paradigm shift, absolutely. The other thing that the organization should think about is that data management is a separate function and requires specialized skills and technology. It's not just I bought or I built this tools and then I can just basically operate it. A third point, I think, is you want to ensure that the technology you use provide a single source of truth, i.e. it's a platform, not a tool. You don't want a collection of disparate software tools with redundant data. And that's what I have seen in most organizations. And finally, I think you need to implement event-driven processes and automated workflow whenever possible.
So, for example, if I think back to when I was at APG, we hired 4 developers, developer, coder, analyst, data scientists on my team intentionally. And the productivity enhancements from automation were immense in terms of what was previously being done manually with Excel, automated via Python, and data integration and effectively creating a data lake. It was very valuable. And let's shift gears again to total portfolio management. So our observation is that's gaining a lot of traction, particularly among our CIO friends at the Canadian plans, including people who've been on this podcast. Would you share for listeners about how that improves, how that potentially both improves performance and integrates into technology, or how technology supports that?
Look, if you think about investment opportunity, at the end of the day, you can take all the investment opportunity and you can, instead of organizing them by asset class, what if you organize them by liquidity, i.e. something that's liquid, very liquid, intraday, something that's liquid on a monthly basis, quarterly, annual, over 10 years. When you look at an investment opportunity, it could be within the very liquid space, i.e. within an ETF. It could be very illiquid where you have to put it into a venture capital vehicle or private equity vehicle. As an investor, you first want to pick the opportunity. Where do you want to be investing? And then decide the structure. For certain investment, it's more convenient or better in one structure or another, more liquid structure or less liquid structure. When you think about investing more based on asset class, then you will have your traditional equity, fixed income, hedge funds, private equity, real estate, etc. Well, the opportunity could be, the same opportunity could be present in those different structures. And I think one of the reasons people think about it this way, because they build separate teams with separate technology infrastructure. I mean, if I look today at our clients, you would see that basically they have total vertical silos. You have the private equity team, you have the real estate team, you have the hedge fund team, you have the traditional team, and each one have their own system, their own risk management, their own. This is not very productive. And that's really not how real life is. Okay. So I think what you want to do here, the reason total portfolio management is a great concept is you basically look at your total portfolio and then you decide based on various aspects, liquidity spectrum, regional spectrum, sector spectrum, etc., how you allocate the money as opposed to on the different. And in order for you to do that, you do need to have the platform that allow you to do so. Having a multi-asset class software platform allow you to handle the entire portfolio as opposed to a siloed approach by asset class would make much more sense and allow you to monitor the entire asset allocation, the performance, and the risk overall.
Yeah, I couldn't agree more. I mean, if I think back to APG and frankly, most asset owners that I've worked at, there has been this siloed perspective where really it's like a bunch of parts and they just end up aggregating into a whole rather than a holistic view. So I completely appreciate why you're saying that could be sensible and an improvement. Let's talk about private credit, because that's something that's burgeoned since the GFC. And my view is, frankly, it will continue to. But my question for you is, but inherently it's private, so there isn't generally public data, and it's generally illiquid loans to sponsor or non-sponsor backed companies. So with that context, how does technology feed into private credit, or any thoughts on that?
I mean, if you think historically, private credit always existed. It was within banks. It was called loans. And banks were basically the one doing that. The problem with banks is that they're regulated entities. And we've seen that with the latest collapse of SVB and First Republic, etc. These banks do have a mismatch, a liquidity mismatch. They borrow short-term, i.e. deposits, and they lend long-term. The advantage of the private funds or the private credit is that the capital is basically, you have an alignment of liquidity. It's a drawdown structure. Investor cannot redeem from these funds, and they get distribution when there is a liquidation event. Therefore, you don't have the issue where you could have a run on the bank, or in this case, a run on the fund. So the funds have the ability to basically be able to provide loans without have to worry about the liquidity. The second thing is that funds tend to be more flexible because they don't have these regulatory requirements. They can be flexible. They can be quick in providing loans. They can provide different loans with different terms and conditions. They can charge more money for certain loans and higher rate for certain loans than others. I think that's what also is attractive in the private loan market, because you're able to charge depending on the type of loans and the various covenants that have been structured within that loan. We have seen loans where the spread basically increases depending on the LTV over time. So if you are able to lower your loan to value, you will get a better spread. Otherwise, the spread goes higher, and these are additional rate of return for the investor. Technology plays an important role because traditionally banks had that technology to be able to manage loans. As more and more investors with these multi-asset class platform are able to invest in individual loans and build a package or portfolio of loans, you do need a technology to be able to manage these loans, to be able to maintain the analytics regarding the loan to value and the calculation of all the interest income and so on. The other thing is there is today a demand for alternative finance. Because of these institutions have much more flexibility. I mean, we see today a lot of NAV financing where basically you can provide financing for an entire portfolio of investment. This could be a private equity portfolio or a portfolio of secondaries that you can finance basically, but provide loan against that one. And we see a lot of the GPs that you taking advantage of that to use that into making distribution to investor or buying additional portfolio of investments.
What about, just completely different question, what about an interesting book you either read lately, ideally, or just that you think is worth reading? And this can be topical and on AI or finance or investing, or can be completely off-piste, and it can be just an interesting book.
Yeah, a book that stands out with regarding to innovation, technology, and investing is The Innovator's Dilemma: When New Technologies Cause Great Firms to Fail by Clayton Christensen. While this is not new, this book, it's been there for a while, but I think today it's more relevant than ever. And that is how disruptive technologies can make or break firms. Today, I think AI is on the cusp of, could be making some firms obsolete and making some firms super successful.
I couldn't agree more. Firms and even industries, and I think.
Yeah. I mean, if you think about today, why certain innovative technologies succeed while other fails. If you think about today, Ford did not invent Tesla. Intel did not come up with the NVIDIA chips and on. I mean, you see that all over the map. This is changing very quickly.
And just as Tesla, to your point, has massively disrupted the big three and auto industry, I couldn't agree more. I think AI will be massively disruptive. Like, for example, if we look at equities, the systematic managers, the quant managers have massively disrupted the discretionary managers to the point where, if some years back, BlackRock said we're getting rid of our large cap value managers because they can't compete with ETFs or systematic managers. And my view is, if you look at private markets, you talked extensively just now about private credit. If you look at private credit, private equity, my view is technology will be as well as even public credit. Systematization, quantitative investing, AI will be massively disruptive to all of those what are currently 99% discretionary investment markets. Curious to hear if you have any further thoughts on that.
I think the investment industry is undergoing significant change as we speak. I mean, you see that already, the move from the active management to the passive management. APG recently announced that 80% of their investment are going to go into basically ETFs, passive investing. And I think that a lot of the investing going forward is going to be relying on technology platform. Really, at the end of the day, what all this technology does, it gives more power to fewer individuals to make more informed decisions.
I mean, I couldn't agree more. But it will be, I think my view is the winners will likely be the disruptors and companies that we haven't heard of yet, as was the case with Tesla and Amazon, and on the list goes. I think it will be very difficult for the entrenched legacy providers to take their legacy philosophy, infrastructure, and retrofit it. What's your view? Yeah.
I think the IBM syndrome continues to exist 40 years later. There's still people today, it's not called IBM, but it's called something else. And people continue to, they do not pay attention to the innovators. They try to follow the traditional incumbents because they're big, they're large, they are behemoth. And at the end of the day, these would be disrupted by newer firms, smaller firms.
I couldn't agree more. I mean, you see the IBM concept every day in institutional asset management, with large asset owners continuing to flock to the large multi-manager funds like the Millenniums and of the world, because no one gets fired if Millennium has an issue, or, and I'm not saying they will, I think it's a very well-run firm, but just conceptually, if they have an issue, you're not getting fired if there's an issue. If you invest in a small emerging manager and there's an issue, the board will say, why did you invest in a small emerging manager?
Look, by definition, the large firms are incumbents and they try to defend their existing business. And this is really the biggest problem to innovation, is that when you have a successful existing business, it's very hard to think about something that would disrupt that. Because while in the newcomer, they don't have a business, they don't have to worry about any legacy. I mean, think about how much bigger BlackRock is going to become. How flexible and how quick are they going to be able to move? And I think that's really the problem. My advice to asset owners and asset managers is not to look and consider the incumbent, but look and consider the innovator, the people who brings new ideas, new concepts, new values, and are not there just to defend the existing business that they have.
I think this is a great way to sort of shift towards the tail end of the discussion, but anything we didn't discuss that we should have, or that you're discussing with other world leading asset owners or managers?
I think that everybody today is really looking at generative AI, and they are basically thinking, how can we, A, take advantage of it, and B, how is this going to negatively affect our business if we don't do anything? And it is difficult because you really need to rethink your business entirely with that one. And most people don't have the time or the resources to be focused on that, so they delegate it. And they delegate it typically to IT team, which maybe is not as knowledgeable about the potential opportunities and risk of the overall business. This is something that I think it's on everybody's mind who's running a business. And how do you, on one hand, take advantage of this new technology, and on the other hand, how you defend and protect your business against it?
It sort of harkens back to what you started the call by saying, which is technology shouldn't be viewed as sort of part of the ongoing maintenance of Outlook and email and notebook computers. It should be viewed as a strategic initiative. And I think here, which is a nice way to sort of wrap up, which is similarly, AI and LLMs and generative AI should be viewed as a step change or a big change, and it's got to be thought of strategically, not by those that are doing maintenance on desktops and email.
Absolutely.
Great. That was a super interesting discussion. Thank you for the thoughts and sharing your most valuable asset with us, your time. We hope listeners have a better sense and appreciation for what one of the cutting edge technology providers is thinking about. And there's some very strong advice there in terms of, or maybe it's not advice, but thoughts or philosophical view on how asset owners and managers should be looking at their technology, and particularly AI and LLMs in the future, and how they could benefit from it. This is your host, Michael Oliver Weinberg, hoping you join us again for our next episode, where we speak with another thought leader who will provide insight into improving alpha via innovation. Thank you.
Thank you.
Thank you for joining us on the Improving Alpha Innovation in Investing ESG and Technology podcast, presented in partnership with Vidrio Financial and sponsored by Alternatives Watch and thefundmarketer.com. Vidrio Financial offers a cutting-edge data management solution that not only collects and cleans your data, but also empowers investment teams to cut through the noise and extract valuable insights for better decision-making in areas such as valuation, risk assessment, and portfolio management. If you're an endowment, foundation, pension, sovereign wealth fund, asset manager, OCIO, or family office facing challenges with your data pipelines, we invite you to connect with us today and explore how Vidrio can seamlessly integrate with your investment team to enhance your data management capabilities. The information covered and posted represents the views and opinions of the guests and does not necessarily represent the views or opinions of Vidrio Financial or our host, Michael Oliver Weinberg. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding investment planning.